The first step in calculating ROI is to determine the monthly revenue and the monthly total cost of electricity. As we've covered, one method of calculating the monthly revenue would be to multiply the hash price times the terahash per second of the specific miner times 30 days in a month. For an S19 XP at the current hash price of 6.4446 cents times 140 terahashes times 30 days is $270.67. Recall the monthly all-in cost of electricity and hosting is equal to the all-in cost per kilowatt hour times the miner's required kilowatts times 24 hours times 30 days. So for the S19 XP, the all-in cost at 6 cents per kilowatt hour will have 3.01 kilowatts required times 24 hours times 30 days in the month times 6 cents is $130.03. Monthly revenue minus the monthly total cost of electricity, we will call the net revenue. For the S19 XP, the net revenue is $140.64 per month. Now, for the grand finale, the final formula, the ROI, and we answer the question, are Bitcoin miners profitable? The ROI formula is a very simple formula. It's the cost of the miner divided by the monthly net revenue. If the cost of an S19 XP is $7,280, then the ROI would be 52 months. But at today's cost of $3,800, the ROI is only 27 months. Recall, this ROI tells you when the miner will break even only on a gross profit basis. It does not include the depreciation and other necessary mining equipment or other operating expenses such as management or payment to the accounting department. So to achieve GAAP net income, the miners must be able to cover all of these expenses before they become obsolete due to new miners being introduced to the market, which have greater or superior efficiency. The operating expenses and other expenses will vary from company to company. With your new understanding of calculating the unit economics for a specific miner or a fleet, you can determine how many additional months the miner will need to run to cover all expenses and still provide an ample return to investors, the owners of the business. Ultimately, I think Bitcoin itself can provide a great return, but the publicly traded mining companies will rarely, if ever, achieve net income profitability once all expenses are factored in. The pace of technological advancements in semiconductor chips will reduce the net revenue for a miner year after year, so that by the time all the depreciation and operating expenses are covered, it will be time to replace the entire fleet. Having said that, the way mining companies can achieve a solid return is by hodling Bitcoin as it rises in price. Personally, I have a hunch Satoshi Nakamoto designed the algorithm with this in mind. Otherwise, a single wealthy individual could accumulate sufficient miners to essentially earn all rewards from the network, as the miners alone provided a net profit, even absent of holding Bitcoin. So the pace of technological change seems to impede the potential for this sort of centralization, a direct threat to the values of decentralization. All right, let me know in the comments whether or not you think that in the long term, these miners will be profitable on a net income basis, and whether or not you see large publicly traded mining companies as a potential threat to the primary principle of decentralization.